Welcome to Market Peeker. Oscillators like the Stochastic and Commodity Channel Index, CCI, help traders spot overbought or oversold conditions and potential reversals. Let's break down how to use them effectively. 1. Stochastic Oscillator. This measures price momentum and compares a closing price to its price range over a set period. How it works. Values range from 0 to 100. Above 80 signals overbought conditions, while below 20 indicates oversold. Pro tip: look for crossovers between the %K and %D lines to confirm trade signals. 2. Commodity Channel Index, CCI. The CCI helps identify price trends and potential reversals. How it works. Values above +100 signal an overbought market. Below -100 suggests oversold conditions. Pro tip: watch for price divergence to spot early trend changes. How to use oscillators effectively. Confirm trends. Use oscillators to confirm signals from other indicators. Avoid choppy markets. Oscillators work best in trending or range-bound markets, but can give false signals in volatile conditions. Combine for strength. Pair oscillators like RSI with MACD or stochastic for stronger signals.